Hello, everyone, and welcome back to the world's best investing podcast. Today, I'm going to explain why I believe that HIMS today is something like Netflix stock 15 years ago. Now, of course, none of this is financial advice. I could be getting this horribly wrong, but I believe I'm going to be very, very right, as I was with Spotify down at $97 when the analysts, quote unquote, to call them something, were saying it was always going to be a terrible business. When people were saying at Palantir at $7 was a consulting business, etc. This is the level of wrong that I think analysts are going to get it with HIMS. So I was just reading Netflix's Q1 2025 earnings report today, and I was blown away by one simple fact, which is if you go back to 2022 and you learn, maybe you witnessed it as I did. You go and study how the market basically left Netflix for dead, and analysts were saying, there's too much competition for this company. It's over for Netflix because everyone now has a streaming platform, etc. The stock went down 70%. Great investors capitulated. You guys know I'm pretty obsessed with this story because it's so important for a number of things. But anyways, all this time, all Netflix was doing, all they've ever done, which has enabled them to go through the great financial crisis, a worldwide pandemic, inflation, this whole thing about competition completely left in the dust. They're doing amazing right now. All they've ever focused on is delivering more value per dollar spent to customers. So simply giving you more entertainment per every dollar that you spend. And you could argue that, well, the user experience isn't perfect. At times they're a little bit woke, etc. Yeah, but most of the people that you know in your life are subscribed to Netflix simply because it's a no-brainer. I don't even know how much it costs, and I have a subscription, and I've never even thought about turning it off because I know that at least once or twice a week or something like that, I'm going to go on Netflix and watch something. For some time, I thought I wasn't going to watch many things on Netflix, and then they came out with a Formula One show. Then I heard about my girlfriend being hooked on this other show, my sister being hooked on another show, etc. So what they have is this ability to over time deliver more value to customers per dollar spent. And this is why, if you look at the graph that I'm seeing on the screen now, which I won't share on this video, but if you go and check out Netflix's cash from operations and free cash flow per share, the current levels are nearly twice as high, or in fact more than twice as high as they were in the 2021 lows, when everyone thought Netflix was undisruptible, in just a few months before everyone capitulated on the stock. So, are we crazy here or what's going on? Why does the market go from loving the stock in 2021 to then hating it just a year later to now analysts saying, well, it's a recession hedge? Not never, but can you believe the level of emotional volatility that people have with this stock, which generally, by the way, I think is indicative of the level of emotional volatility that people have with any stock. HIMS, just a month or two ago or something like that, trading at $72. Now, every time some guy, the president of some nation, comes up saying something about tariffs, be it China, any other country, whatever, who cares about them, right? Every time that happens, HIMS drops a little bit. But now, of course, the performance from a year ago is incredible. I bought this stock at $15 and now it's down to $25, and we'll wake up tomorrow and then there will be some good news and then we'll go up to $30, etc. We're in that yo-yo / kangaroo kind of market. But the point is, so much emotional volatility, but these are real businesses. Stocks are not pieces of paper. They are essentially small bits of a business. And so if the business does well over time, then the stock goes on to do very well. Now, it actually takes a long time for a business to be created and for it to get strong. So you're not going to get rich by buying a stock in 5 minutes or in a quarter or something. It's going to take years and years. But it's interesting. I missed the Netflix opportunity in 2022, which is why I'm so obsessed about it. But I definitely didn't miss Spotify. And I'm up over, I think, nearly 6x on my Spotify investment. Analysts were saying this was always going to be a terrible business, etc. The point is that it pays a lot more to be focusing on businesses than on stocks, because if you actually get good at spotting good businesses early, then you can make a lot of money. It doesn't take 5 minutes, but in the case of Spotify, it took a few years because I've got my entire portfolio back from this one concentrated investment. To be honest, if you look back in hindsight, it was pretty obvious that everyone was using this app. It basically had no competitors. Yes, the economics were bad because labels were taking 75% of the money, but who cares, because they were deploying audiobooks and podcasts, and then that was going to make the unit economics a lot better. Voila, a few years later, free cash flow per share has gone through the roof. So going back to Netflix, all they've ever focused on, and it's incredible because if you go through the earnings calls, you will see all they talk about is just their content slate and focusing on delivering more value to customers, and only really raising prices when they feel customers have gotten a lot of value from the last investments. Guess what? It's the Costco algorithm. It's all Costco has ever been focused on. It's all Amazon, which is an instance of the Costco algorithm applied to network effects, has ever focused on. All these companies are genetically the same. Amazon, Spotify, Costco, Walmart. Now, they're all the same. And now it's Duolingo and Hims, my two latest bets. Of course, I could be getting this wrong, and of course, none of this is financial advice, etc., all of that. But if you look at the execution for Hims management, it's been flawless. All they are doing is delivering more value to customers per dollar spent. And a lot of people say, well, Amazon is going to disrupt this company, etc. Well, not really, because Amazon has made 4 or 5 attempts to do so, and they failed. And they've had to acquire new companies, rebrand the operation, etc. Walmart tried to do this, and they had to close their telehealth operation last year. And you have the entire $4 trillion healthcare industry, which one would expect, if Hims is really that easy to disrupt, then someone would have done it. But regardless, Hims's free cash flow continues to compound at breakneck speed. It's rising faster than Palantir's. So, apart from the long-term implications of Hims doing what it's doing, which you guys know, I think, is about them bootloading an AI that makes healthcare more efficient for everyone, here's what I think people are missing. Obviously, the fact that Hims is executing the same playbook as Netflix, but applied for healthcare, and they are doing so perfectly. So, as has happened with Netflix and Spotify, the market, in my view, is going to go from very quickly saying this business sucks, etc., to basically loving it, as has happened with Netflix and Spotify. The other thing they are missing is something that became very apparent to me during Netflix's Q1 2025 earnings call. Netflix co-CEO Greg Peters said during the call that buzzy titles, so the titles everyone hears about that are the hottest in the quarter in question, drive less than 1% of total viewing hours. What that actually tells you is that Netflix's business is mostly this highly complex user experience optimization game in which they connect users across the globe with very different cultures, etc., to whatever content they're going to like most. And in this endless sea of possibilities. Now, these are 700 million customers they have in 300 million households, and just so much content worldwide. Again, you could talk to people, and qualitatively they will say, well, I think the user experience on Netflix sucks. And as people might say, they use Apple Music and Amazon Music instead of Spotify. But if that is true for everyone, then why do Netflix's financials continue going through the roof, where the rest of the platform's really not doing so well? It's the thing with networks is the experience of an individual, or even if a collection of individuals, doesn't necessarily communicate the value of the network. If the network delivers marginally more value per dollar spent than other alternatives, then people are going to naturally gravitate to that. And because in the digital space, all customers have to do to choose between one service and another is literally slide their thumb a little bit to the left or to the right, then what you get is an exponential advantage in terms of adoption, which, if the company in question is well managed, that's going to translate into a lot more capital put into the hands of that company, which, well reinvested, is just going to revamp the value per dollar spent equation further, which is going to drive further network effects. That is what has happened with Netflix. That is what has happened with Uber. That is what has happened with Spotify. That is what we are seeing happen with Hims in the very early stages. Because yes, there's a lot of risk in this company because it's a young one. There's regulatory risk, etc. But this whole argument about saying, well, Amazon is going to kill the company is very lazy now. It's intellectually very lazy. Because guess what? That's what people were saying about Spotify 2 years ago. That's what people were saying about Netflix regarding Disney and other companies a few years ago. And it just comes down to, if you buy a company that's unreasonably focused on improving patient, in the case of HIMSS, patient outcomes per dollar spent, generally the equation is, if you buy a company that's unreasonably focused on delivering more value per dollar spent to customers, and the whole organization is culturally geared towards doing that, then success is very likely over time. It doesn't take 5 minutes, it doesn't take a quarter, it takes years. But then once value compounds. So it's pretty incredible now to see many people believing now that Spotify and Netflix are near undisruptible. And it's true. But it was also true 2 years ago, when these stocks were trading at much, much lower levels. Like Netflix is up 400% since the lows in which people capitulated. Spotify is up nearly 6x, actually more than that if you bought at $70 at the peak of the pessimism. So what I'm saying is that really, HIMSS is an instance of what I call the Costco algorithm. All of these companies have the same genetic traits as Costco. People in these companies are unreasonably obsessed with delivering more value per dollar spent. And it's obvious really you can assess this in many ways, but basically these companies have two things in common at any point in time. One, the user base grows incredibly fast, much faster than would otherwise be reasonable, and they produce positive cash from operations. Obviously the thing that enabled me to make that big Spotify bet was the fact that the market was focused on the income statement. So it was a very lazy argument to say, well, this company is not profitable, as was the case with Spotify, and therefore to discard it. But the problem is that when you analyze high growth companies, obviously they have non-cash expenses, which make the income statement look worse than it actually is, or sometimes you can make it look better. But what you can't actually modify is cash from operations. So usually when you have a network that's growing very fast and the cash it produces is growing very fast, what you have is an extraordinary management team that infuses this organization with this world-class process power that then enables the organization to, against all odds, deliver more value to customers per dollar spent on whatever the domain of operations is. Whichever way you look at HIMSS, that is what's happening now. And so, and you could also say that HIMSS is something like Spotify 10 or 15 years ago, because Netflix and Spotify are genetically the same. The thing is, I assume, of course, I could be getting this wrong, but generally the way you make money is if you have the training to identify this sort of companies early or at any point in time, and you're able to buy and hold on when the market is really having an emotional reaction, then that's how you make money. This is really the name of the game. So really, if the stock market goes down, you can't get deflated. It's like if you were a football player and you go out on the pitch or something and you get deflated as soon as you hit the pitch, then you're going to suck. It doesn't work like that, does it? People go out and play. Well, the stock market is the same, but you really have to be focused on fundamentals. Now, what else did I want to talk about? Yeah, so I was talking about the whole thing of 99% of growth or of watch time, TV watch time, being driven by the non-buzzy titles. And so when you look at HIMSS, the market is obsessed with the GLP-1 thing. But even though management keeps saying that actually most of the growth is driven by the other verticals. So the thing with people saying that Amazon is going to kill HIMSS is they continue to misunderstand the moat that is optimizing user experience across a highly complex game. In the case of Netflix, it's complex enough that obviously everyone else has failed to beat Netflix. And they have the prime financial performance, which now the market is rewarding. With HIMSS, it's they play the same complex game of optimizing user experience, but they do so across a growing volume of subscribers, obviously, and across a growing domain of healthcare verticals. And so doing that in a personalized manner at scale is very hard. But if you think about it on a first principles basis, HIMSS's moat, the moat that HIMSS is building, because this is a young company, is essentially Netflix's plus a component of at-scale personalized compounding. So obviously there is a moat. And if there actually weren't a moat, then the company wouldn't be printing free cash flow the way it is. Because you could argue, well, someday Amazon is going to wake up and do something great in healthcare. Truth is, that hasn't happened yet. And the rest of the industry hasn't been able to. Apple has tried to get into healthcare. No one has been able to. So statistically, this is a lazy argument. It's equivalent to people saying in 2022 that Spotify was always going to be a bad business because of labels, blah, 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 etc. We've seen how this has played out. So, and then in this episode that I saw from Him's House, a podcast they made with Him CEO Andrew Dudum, Andrew was explaining the thing with GLP-1 as, well, it's like back in the day when every single analyst was focused on whether Amazon was going to close a deal with whoever it is that owned the rights to the Harry Potter books in one quarter or another, and therefore how should they change their models? Completely pointless stuff. The thing with GLP-1s is the same for a number of reasons. I talked about how GLP-1s are a type of peptide, and they're actually just one of thousands of peptides in the human body, and therefore a tiny subset of $1 trillion opportunity that Hims has ahead. But then if you look at it from a more at the kind of platform level, well, most of the growth is not coming from GLP-1, and it's the same as Netflix. 99% of the growth, the traffic, etc., comes from this long tail of essentially healthcare conditions and patients with different conditions, different attributes, etc., that the platform has to solve. So just technically at the platform level, none of what the market is saying about Hims makes sense. Then analysts now are saying that Netflix is a recession hedge just because people are very unlikely to cancel if things go wrong economically. And you could attribute that to the resilient nature of the entertainment business. But the truth is, if the value per dollar spent equation for Netflix sucked, you would cancel it, no matter how resilient the entertainment business is. With Hims, it's the same. And of course, there is risk. This is a younger company, but so far the execution has been flawless. And so a few years from now, it would be fair to assume that the moat and the resilience of Hims' business in the face of economic hardships would be even bigger, would be even stronger than Netflix, right? Because if you have Netflix, if you have a Netflix of healthcare, it's fixing important healthcare problems for you, while Netflix itself is actually just keeping you glued to a screen. That's kind of a pejorative way of putting it. It's entertaining you, but you could at least argue that solving healthcare problems is as important as entertainment. More reasonably, you could say it's actually more important than entertainment in the first place. So really, the business that is being built is very strong. The execution is flawless. This is a perfect instance of the Costco algorithm, or as it pertains to the scope of the video, it's actually, Hims is executing the Netflix playbook perfectly. And so this is just a whole emotional reaction, which is very similar to the one we saw in 2022. And yeah. So what else did I want to talk about? Yeah, well, generally, the idea that economies of scale shared is the most powerful thing in capitalism. So the Costco algorithm, the essence of it, everything, what Uber does, Spotify, Netflix, Costco, Amazon, Walmart, etc., all they do is focus unreasonably on getting customers better deals over time, so more value per dollar spent. And then the capital they get from that, they reinvest in order to basically lower prices for customers and give them an even better deal over time. That is called sharing economies of scale. It's the most powerful force in capitalism. And so going back to the idea of entertainment being resilient and therefore now Netflix being a recession hedge, that happens with any business that truly pursues sharing economies of scale with customers for long enough. Because then it gets to the point where it's a no-brainer to buy from this company. Happens with Costco, happens with Spotify, happens with Amazon, Netflix, etc. Customers trade up or down, but essentially they are still buying from the company in question just because it's so hard to replicate what they do. And so quarterly, people panic with GLP-1s, numbers up and down, and the margins, revenue, guidance, which I think is the stupidest thing. Look, it's good to keep check of a management team, but you shouldn't cheat yourself out of a wonderful long-term investment just because a company didn't manage to exceed an arbitrary number, right? So for me, quarterly Hims is about assessing whether they continue to execute this playbook well or not. And so far, the execution has been flawless. Of course, I have a portfolio of concentrated asymmetric bets that has done very well, right? With Palantir and Spotify combined, returning my entire portfolio twice. So I can assume additional risks. But here, what I see is just the perfect instance of this playbook but applied to healthcare. So I think this business is actually going to get huge over time, and we're just at the beginning of this. It takes years for things to work or not work, because sometimes mistakes do happen. But for me, this is just a perfect instance of the Costco algorithm, of the Netflix playbook, whatever you want to call it. So guys, that's it for today. Thank you very much for joining me. As always, if you enjoyed this update, could you please share this with one friend whom you think will enjoy it? Everything I do, all my work is for free, apart from my course, which, by the way, you should take if you want to get good at spotting instances of the Costco algorithm. And so the only way this grows is with your help. Thank you very much in advance for sharing, and see you next time.